but the development project could have actually failed. So please remember, the development attempts that are aborted can still be qualifying. So what does this mean in plain English? So over the last 15 years, the easiest way that we found to explain this tax relief is to refer to 3 tick boxes. You have to tick all 3 boxes in order for a claim to be successful. So you have to be making a technological advance. You have to be overcoming technological uncertainties. And how you overcome these uncertainties can't be readily deducible by a competent professional. But again, what does that mean in simple terms? So let's have a look at 3 tick boxes in a bit more detail. I'll just drop back a few slides here. So we will start off by looking at what is defined by a technological advance. Again, it's easier to explain what a technological advance isn't. So it doesn't have to be blue sky, innovative, or groundbreaking. In fact, we never use the word innovative when dealing with an R&D claims because we think it's misleading for clients. Companies do not have to be doing something that's innovative in order to claim. So if we just go back to the rationale behind the legislation, what the government is trying to do is to give an incentive to you to increase productivity by making developments in your products. The legislation is not just about incentivizing Sir James Dyson, kind of his revolutionary dual cyclone vacuum cleaner. It's about genuine UK businesses and helping them develop their products and services. And the legislation was written to have a much wider impact than just applying to companies' innovations. So what we're looking at are firms that improve the manufacturing of existing products, design and develop new products, change the way that they're making products, and or improve their processes. All of these activities can be eligible. So it's not just restricted to scientists in white coats in laboratories. And in fact, companies are actually doing R&D without knowing it. And as a result, they're missing out on what I consider to be the most generous tax relief available in the UK today. So the advance can be anywhere in the value chain, from the raw materials through to waste, or indeed the processes you go through. And the company does not have to be developing the first ever product of its kind. The definition is much wider than most companies and accountants perceive. So the advance, therefore, can constitute making something cheaper, making it smaller, larger, or longer. And the advance in the technology occurs when the company is making an appreciable improvement to an existing product or process. Now, sometimes and often, this is simply duplicating an existing product or process and making it more cost-effective or bespoke to a particular customer's set of requirements. Now, the second tick box is technological uncertainty. And these are probably the two most helpful words in the legislation. So when we're looking at technological uncertainty, it's very important to ask the competent professional. Now, in most cases, this is the technical lead on the product. We're no good asking the finance director what the technological uncertainties are, as they would most likely not be competent in the first place in making that judgment. So we're looking for the person with the relevant experience and expertise in the given industry. And all we simply ask them is, what was hard about the product? Where were the technical blind alleys? So we see technical uncertainties in almost every industry. We see it in almost every manufacturing company in terms of cost, space, regulation, materials, and waste. We see it in the software industry, which often arises where you may be combining off-the-shelf, predictable applications, but you are dealing with integration uncertainty. You can even see it in the construction industry, where you may be using new raw materials or using known methods but in a different environment. I'll go through some examples for you in a moment. So when we're looking at technological uncertainties, it's very important to ask the competent professional what they are. Where are the head scratches? Where are the blind alleys? Where have they had trouble and difficulty? If we're asking the correct competent professional, it's likely that they will have the relevant experience in the industry and the relevant qualifications. So if they can answer the question and they can come back and say, well, actually, yes, this was difficult, this was hard, then it's likely that we're able to tick this box. Finally, the third tick box, that the technological uncertainties cannot be readily deducible. So what do I mean by readily deducible, and how can we demonstrate this? As a general rule, we sometimes like to find out how much or how long it's taken to overcome the technological uncertainties. If a project took a weekend, or even just a week, it's a pretty good indication that the technological uncertainties were readily deducible. The key with this tick box is to find out how the technological uncertainties were overcome too. So if a company was simply copying someone else or following routine or standard methodology to get the desired outcome, then the project will probably fall down on the readily deducible test. So what we're looking for here are projects where companies are having to solve issues by going outside the norm and the outcome was not predictable. So we'll just move on now to industries where R&D can typically be found, and perhaps some industries where you wouldn't expect to find R&D. And we always say at this stage, to keep an open mind, don't be closed-minded about this. It's often the big D, big development, and little research, little R. It's not always obvious where the R&D is. So we might be talking about an internal software system, a new piece of clothing that's being developed, perhaps a baby bottle or a drinking cup, or foundry industry, for example. You wouldn't expect to find research and development in the foundry industry. So it usually comes out of bespoke customer requests. All manufacturing businesses should be considering whether they're doing some R&D. It may not be the entire business itself that's undertaking R&D, but there may be smaller projects in the business where we can actually make a research and development tax relief claim. So I just want to go into a bit more detail at this stage and look at software development. Now, the subject of software development, we're either talking here about the end product, so an application or a platform, or software that's being developed for a company's own use to make it more efficient. So this is particularly relevant for either software companies or companies that use software, where software is an integral piece of that company's operations. So what's the best way to describe qualifying R&D in the software world? Well, when we're looking for qualifying projects, we're not focusing on the commercial or the end product so much as the fundamental mechanics of how we arrived at the end result. So in other words, it's the journey that's been taken by the client. So we often see inquiries in the claims department where the accountancy clients have written reports stating that the advance is a creation of a project which does X, Y, or Z. But that's not the correct test for R&D purposes. The test for software is the development of the underlying complex algorithms that have been created to make the product, and those algorithms can only be the subject of an R&D claim if they were developed where there is no established methodology. So when writing an R&D project, the first thing that we need to identify is where the advance has been. So just because something was complex or time-consuming and difficult doesn't necessarily make it R&D. But also, just because there was no product on the market that did the job, again, that doesn't make it R&D. So what we need to do is we need to distinguish between using established techniques or development tools and methodologies and actually developing something that's new, developing new algorithms and developing systems where pieces of software that haven't talked to each other before, disparate systems, can actually now talk to each other. So just because there's nothing like it doesn't necessarily mean that it'd be qualifying R&D. I'll give you a few other ideas on where we may be with R&D in terms of qualifying claims. So complex integrations that have never been done before. So a website front end and perhaps a legacy back office. Perhaps where we're reverse engineering technology or hacking into old systems to bring them up to speed with current systems. If we're looking at mobile and static technologies and getting them to communicate with each other, or perhaps looking at different operating systems and getting them to communicate with each other. This is typically where we would see R&D within software industries. So I just want to go through and look at grants versus R&D tax relief. They're both ways in which the government provides valuable financial support, and that's why we're adept at identifying these for our clients. In terms of grants and R&D, here we're looking at the past and the present. However, there has always been a myth that grants and R&D tax relief are mutually exclusive. We would like to put this myth to bed today. if a company claims a grant, you can also claim tax relief and even a tax credit. How much you can claim will depend on whether you're receiving state aid or a non-state aid grant, and the definition of the two is fairly complex and will be decided on a case-by-case basis. Now, the SME scheme for R&D tax relief is generous enough to be considered itself state aid. So as a general principle, any company can only claim one piece of state aid per project. Therefore, if a company has received state aid grant for a project, it cannot claim R&D tax relief under the SME scheme, but it can claim R&D tax relief under the large company scheme. Now, the large company scheme is less generous than the SME scheme, but it does give a company an opportunity. If they have received grant funding, they can also still claim R&D tax relief on effectively any remaining balance. But like I say, it's not as generous as the SME scheme, but it's still an opportunity there to claim that balance. So what we're trying to say here is don't just think about the R&D tax relief, think about what grants are available as well. And in some situations, cash grants can be far more generous than the actual R&D tax relief itself. So again, looking at the past and the present, it's a case of looking at what options are available and making a decision based on what grant funding is available and what the R&D tax relief position looks like. Through a simple questionnaire for everybody. If the answer is yes to any of these questions, then the company might be able to claim substantial cash back from the revenue. So if you're undertaking the development of new products and processes, if you're creating new or improved products, if you're aiming to duplicate existing products or processes in an appreciably improved way, if you've made advancements in the field of your work, if you employ technical staff, engineers, software developers, scientists, architects is a very important part of R&D at the moment. Or do you spend money on staff costs, consumables, or perhaps subcontractor costs in order to undertake development work? These are all the sort of questions. If you're answering yes to any of these, then it's worth having a look at the R&D tax position to see whether you qualify. So giving you a brief overview of the R&D tax relief scheme, what the qualifying criteria are in terms of hitting those three tick boxes. So let's have a look now on how you actually quantify the claim and what costs can be included within the claim. But first thing to note, they can only be claimed for revenue expenses. That's effectively costs that are incurred in the day-to-day running of the business. So we can't include it for any capital assets such as buildings or equipment that are expected to last for some years. However, having said that, capital expenditure in some instances can qualify if we're effectively capitalising staff costs, for example. So effectively it's a revenue expenditure, but we're capitalising it. We can still include that within the R&D tax relief claim. Or your other capital expenditure will be, the tax relief for that capital expenditure will be via capital allowances. So in contrast to R&D tax relief, R&D allowances can actually be claimed for unincorporated businesses. So that's another avenue to look at. But with qualifying R&D costs, there's effectively 5 that we're looking at here. We're looking at staff costs for anybody that's involved within R&D projects. That's effectively everything that would go onto a PAYE slip, but doesn't include dividends. We're looking for any material and consumable costs, so items that are being used in the process that are not ending up as part of the finalised project. Any software costs, and we're talking about specialist software here, so like CAD, MSDN, MS Project licenses, software licenses such as Word, Excel, we wouldn't be able to include. For some industries, it's relevant to include a proportion of light, heat, and power costs. And for a lot of development companies that are undertaking R&D, we can actually include subcontractor costs. Now, this actually is capped at 65%. And the reason for that is that the revenue recognise that there is an element of profit within all subcontracted work, and they've taken a blanket view that 35% is the profit level for all subcontracted work. So for the vast majority of clients, the SME scheme is the relevant scheme. There are 2 schemes available. There's the SME scheme and the large company scheme. Like I say, for the vast majority of clients, the SME scheme is actually where your tax claim will be made. And the reason for that is that we're looking at 3 criteria for an SME scheme. The first one is you must have fewer than 500 employees, and then we look at turnover and balance sheet test. So if you've got fewer than 500 employees and your turnover is less than 100 million euros and your balance sheet is less than 86 million euros, then you would qualify for the SME scheme. If you go over 500 employees, then we look at the turnover and balance sheet test. And if you fail both, then you go into the large company scheme. Like I say, for the majority of clients, it's the SME scheme is the one that's most relevant. Now, it's very important at this stage when we're looking at the SME scheme that we need to look at the company as a whole. So if the company is part of a group, then the whole group must satisfy these tests. So as part of the due diligence stage, it's important to understand what the group structure looks like to ensure that we don't miss any linked or partner enterprises. We can run through this with you as part of the pre-qualification for the R&D tax relief scheme and get a better understanding of what the business looks like. And then we can discuss what the position is for the SME scheme and then what the position is for the large company scheme at that point. So what does the tax relief look like for an SME? Well, from the 1st of April 2015, SMEs receive an additional 130% uplift on their revenue expenditure on relevant costs identified. So if we take, as a simple example, an SME spending £100,000 per year on qualifying R&D, they will receive an extra 130% of tax relief. So effectively, what the revenue is saying is you've spent an extra £130,000 on qualifying R&D activities, and this obviously then reduces the corporation tax rate. Now, for the eagle-eyed ones of you out there, you'll notice that the SME tax rate of 20% isn't correct anymore. It's actually 19%. So it'll be worth approximately just slightly lower than £26,000 in tax savings to you. As I said from the start, this is available for profit-making companies and loss-making companies. So if you're a loss-making company, you can claim that you're effectively going to tax credits back from the revenue, and this is at 14.5% of the qualifying expenditure. And we can look back. We call it the past, we can look back for 2 complete financial years. So if we take today's date, for example, we have until the end of September, for any September year-end clients, we have to the end of September to go back and do the 2015 claim and the 2016 claim. And obviously, once September lapses this year, 16 is still available, but we lose the opportunity to do the 2015 year-end. So, having had a look at the past on the R&D tax relief, I'll very quickly run you through grant funding and how this may be applicable. So over recent years, the range of grants that are available has expanded significantly, and the scope of the qualifying criteria has widened. However, navigating through this is time-consuming and frustrating, and due to a lack of awareness of exactly what grants are available, companies are actually missing out on funding which could be vital for them. Now, grants range anywhere from £50,000 to £3 million, and they will typically fund 70% of the total project cost. There are some schemes out there that will fund to 100%. So, how do we spot an opportunity of when somebody is actually looking for grant funding but actually finding something that's relevant for them? There's a multitude of different reasons for why a client might want grant funding, but it must be secured before any money is spent on the proposed project. That's what we call it the present. So a couple of examples of why you might want grant funding, perhaps a new piece of capital equipment. We're probably looking at about £100,000 worth of spend there. For a new R&D project, so it's got to be innovative, must have a high technical risk and a large market potential. Maybe a property acquisition, but we're looking at the creation of new jobs there. But it might be that you want to investigate the commercial or technical feasibility of a new business idea. So if we think grant funding is relevant, how do we qualify for the grant funding scheme? Well, effectively, there's, again, 3 tick boxes for grant funding. And the bar for grant funding is slightly higher than it is for R&D. So what we're looking at here is innovation, technical risk, and market potential. So in terms of innovation, we're talking about something that's new to the industry or the market, something that creates a significant improvement over existing products or processes. And like I said, the technical bar is slightly higher than it is for R&D. In terms of technical risk, we're talking about something that has a high technical risk and high technological challenges. And this will actually be evaluated by an independent technical expert. There's a slight difference between how the R&D tax relief works and how grant funding works. The grant funding application will actually be evaluated by an independent technical expert who will decide whether there's sufficient technical risk there to qualify for the grant. And then the third tick box is looking at the market potential. So what's the market size? Is there a clear route to market? UK and European companies of all sizes are eligible for a variety of the grants and the funding. The big difference between R&D tax relief and grant funding is that grant funding is very competitive. There is a fund of money and companies are competing for a slice of that pot. Whereas R&D tax relief, as long as you meet the qualifying criteria, you can claim the relief. So I'll just give you a quick example of where we've helped a company with grant funding. This actually relates to Heathrow Airport. So it was a brand new startup company, had no employees, but they did have an idea for a unique charging system for taxis at the airport. We managed to actually fund them at 100%. The project value was £3.1 million. And the project was for them to develop and install a new way of charging at the airport for electric taxis. It's actually a very important project for the UK. Heathrow has already come back and actually said the project was successful. The reason where the technical risk was and the innovation was is that these electrical vehicles needed a huge amount of charge in such a short space of time to actually keep the flow of traffic moving. Now, at the moment, only diesel or hybrid taxis were going into the airport, and the technology behind this was similar to mobile phone chargers, a huge battery, 1,000 times bigger than mobile phone chargers. They were installed at Heathrow. And the problem was that if you used all the grid power to charge a battery bank, it just wouldn't work. So they had to come up with a new way of charging these huge battery banks and being able to use them for charging electric taxis to be able to use at Heathrow Airport. So that's one example of projects that we've used, or companies that we've helped with grant funding. Obviously briefly touched on there, the percentage of the total project cost is typically 70%, but that can also be up to 100%. And we do need to demonstrate the market potential to the fund as well. So if we have a look at the future, here we're talking about Patent Box. So Patent Box is a regime introduced by HMRC that effectively allows you to pay an effective corporation tax rate of 10% for all intellectual property that we can put within that box, within the patent box. How does it work in reality? Well, at the moment, non-patented products, as examples, 100% of the profit is attributed to a corporation tax rate of 19%. But actually, if we can get patented products, then we can actually split out the profits that are applicable to corporation tax, and we can apply a 10% high-level 10% rate of corporation tax to some of the revenues generated, some of the profits generated off the back of the patented products. So what can we put into the box? Well, effectively, we can put any patents that are granted within certain jurisdictions, any exclusive licenses that you may have that you're using within the day-to-day running of the business. Now, we can't do that for all countries. So some countries, for example, like France, you can patent your grandmother in France. Unfortunately, we can't put that within the patent box regime. We can't use Spain or Italy otherwise, but we can use other countries. You can see, the vast majority of Europe there, obviously Portugal to the side as well. So really, this is an opportunity to review any patents or any patentable technology that you have and see whether it's worthwhile gaining a patent to put that into the patent box regime. Again, that fits within the past, the present, and the future. Now, what are we talking about here? Well, if we use an example of a printer and a printer cartridge, it's a relatively straightforward example. At the moment, if they have sales income from the sales of printers, and it's a relatively straightforward printer, that wouldn't qualify. However, if they're using a brand new inkjet cartridge within the printer that has a patent on it, then the income from the sales of the inkjet cartridges can be included, and the income from the sales of the printer can be included, even though the printer itself doesn't have a patent on it. So what we're looking at here is something, if the inkjet cartridge is integral to the operation of the item being sold, i.e. the printer, and it's intended to be used for its useful life, then we can include income from both elements within the patent box regime. Just to run through that example again, take for example a standard shaver. The new fancy 5-blade shavers, if there's a patent on the shaving head, then again we can include sales from the shaving head within the patent box regime, and also the sales from the actual shaving stalk itself, because the shaving head is integral to the operation of the item being sold. So, can you apply for a patent? And the answer is yes, you can. In order to apply for a patent, we're looking at 3 criteria here. So there needs to be an inventive step. So it needs to be new, something that's not in the public domain. So it can't be on a website, it can't be in any marketing material, people can't be talking about it. It also can't be obvious. It can't be obvious to someone that is skilled in a relevant field. Now the bar for this is set quite low, so don't assume that you are clever. The bar is that if somebody that invests in these things, then you're going to see that everything is obvious. It can't be obvious. But if it's novel, and if you ask, there's 2 questions. It just can't be obvious. And the third criteria is that it can't be excluded either. So if we can meet those 3 criteria, then we can apply for a patent, and we can then start to look at the patent box regime. So talking about past, present, and future, what does the program of support look like? Kind of the next stage from the webinar, how do we go about assessing R&D tax relief credit eligibility, grant funding eligibility, and whether patent box is something that's worth considering in the future. We have a dedicated team of technical tax consultants that run our R&D tax relief team. We have a team of patent attorneys, and we have a detailed calculation system that's been developed alongside the revenue to support all our reporting documentation. There's also a patent box calculator within our website as well. So I'll leave it there for everybody. Open for questions and answers if people would like to fire questions across. I'll quite happily put a bit of time aside just to answer those. Hope it was useful. And like I say, any questions, send them across now, or my email address is at the bottom there. Feel free to email them across.
Okay, so if there's no actual specific questions, then I'd just like to say on behalf of Chapman Robinson & Moore, a big thank you to Nick for spending some time with us today, and also then delivering this webinar for us, sharing his expertise, knowledge, and obviously giving us an overview in terms of the opportunities that are available to all of us, whether as your accountants or as yourself as business owners. So thanks again, Nick, for your time. Thanks for that contribution. Of course, if anybody does have any questions after the webinar, then please do contact us through the communication channels that you have with us, or follow us on social media, and we'll keep you updated of the latest developments of the work we do in partnership with Abbey Tax. But again, thanks, Nick, and thank you all for joining us for our latest webinar. Please follow our events page for our forthcoming webinars. Our next actual seminar is going to be on the new GDPR or data protection regime, and our next webinar will be on the Zero software. And hopefully you can join us again in the future. Other than that, wish you well for the rest of the day, and thank you for joining us.